least 20,000 Missouri residents are expected to lose their homes to foreclosure by the end of 2009. Thousands more who've already fallen victim to the mortgage crisis might have been able to save their homes but did not ask for help. Tonight, you'll hear from experts with local nonprofit organizations who are dedicated to helping preserve the single most important investment many Americans will ever make. Good evening. I'm Ruth Ezell. For the next hour, we'll discuss a number of issues surrounding the mortgage crisis and specific steps homeowners can take if they've defaulted on their payments or are in danger of doing so. Our studio audience includes concerned citizens from across the St. Louis area. And in the second half of the program, we'll be taking some of their questions. Panelists will also take your questions by phone and email. You'll notice two people on set with laptops. One is taking your email questions, the other one is Twittering. Right now, a look at why we now find ourselves in the midst of a mortgage crisis.
They are about to discover the meaning of the great thrill in American life, the owning of your own home.
The American dream became reality for millions of families in the period following World War II. New working-class suburban communities like St. Anne, Missouri, with row upon row of modest, affordable homes sprang up across the country. More than a half-century later, the dream is slipping through the fingers of a growing number of bi-state region homeowners. Foreclosures are up, home values are down, credit is tight. This was caused in part by non-traditional loans used to increase the rate of home ownership.
It really was extending access to mortgages to non-traditional borrowers, those who couldn't qualify for a conventional conforming loan. And in fact, not only the subprime market, but other features did increase the homeownership rate up close to 70% by mid-part of this decade. But as we know, there were a lot of problems associated with that.
But Federal Reserve Bank of St. Louis economists William Emmons and Yulia Demyanek say subprime loans are not the sole contributors to the mortgage crisis.
The crisis is everywhere in all of the segments of the subprime market, in the adjustable rates, in the fixed rates, in the broker-originated, in non-broker-originated home purchases, home refinances. Is everywhere to a certain extent. International Monetary Fund, IMF, they have numerous studies on the lending boom and bust cycles for the different countries. And U.S. in that respect is not the first country, or this is not an isolated crisis, and we are not much different maybe apart from the size of the bust.
Although a number of factors played into the mortgage crisis, there's no doubt that one of those factors, subprime mortgages, rose in popularity until that market crashed last year. Subprime loans made up just 7% of all mortgages written in 2001. By 2006, they rose to 20%. Then when you add in home equity loans and lines of credit, which ended up being riskier than many homeowners expected, plus a non-traditional form of mortgage known as Alt-A, a more dramatic picture of the credit boom emerges. At their peak in 2006, subprime, home equity, and Alt-A loans made up almost half of all mortgages originated that year. They translate to more than $1.4 trillion.
In addition to that cyclical behavior, there's also a very clear trend over decades in the United States and in other countries of increasing mortgage debt. And that put cumulative pressure on the ability of households to continue to pay the mortgage.
These maps from the Federal Reserve in New York illustrate how foreclosures are affecting not just urban neighborhoods in St. Louis City, but also in St. Louis County, in St. Charles County, Jefferson County, and across the Mississippi River in Illinois. The majority of these foreclosures tend to be clustered in more densely populated areas.
Our region is not the worst, but it certainly has been heavily affected. And that's the case across the country. Even those areas that didn't have very large active markets with non-traditional loans, even those places that didn't have booming housing markets with double-digit price increases, still every area is being affected.
The worst-case homeowner scenario, home foreclosure, might have been prevented in some cases had consumers reached out for help.
Don't avoid it. Don't put your head in the sand. Open your mail. Answer the phone. And then let's look at how we can keep you in your home.
Bringing together agencies like Beyond Housing to stem the tide of foreclosures is a top priority of the Federal Reserve.
We're participating on a number of collaborative efforts in the community to try to get the word out to consumers that there is help available if they call in time.
Many of the agencies networking with the Fed are also taking part in a series of foreclosure clinics organized by the office of U.S. Senator Claire McCaskill.
We have just gathered together the experts, all the people in the community that can help.
At this clinic, June 28th, on the campus of the University of Missouri St. Louis, attendance fell far short of what you might expect given the magnitude of the crisis.
It's not surprising that people aren't anxious to come out in public and say, I'm facing financial problems. But in every instance that we've had these clinics, we have been able to document that we've been able to save people's homes. So the good news is that there will be some positive things happen as a result of this clinic.
Stephanie Boykin and Mike Person, prospective home buyers who are engaged to be married, found the clinic to be the proverbial ounce of prevention.
People that may be in a position where we are, where we're looking for a home and we're looking to finance a home, we want to be proactive. It's important for people to educate themselves and understand what kind of loan package they're getting into. And for those that have already on the edge and already start getting notices in the mail, please know that there are resources out there that can assist them in staying in their home.
And it's time now to put you in touch with some of those resources. On our panel this evening, Malik Ahmed, CEO of Better Family Life Incorporated. Since 1983, his organization has run programs to advance the health and prosperity of the American family. Dan Claggett, manager of the Consumer Unit with Legal Services of Eastern Missouri, which provides civil legal assistance to low-income Missourians. Linda Ingram is Director of Post-Purchase Services with Beyond Housing. That organization provides affordable housing and home ownership services to families and senior citizens. And Eric Madkins is Director of Housing for the Urban League of Metropolitan St. Louis. For the past 89 years, his organization has worked to improve the lives of African Americans and others in the St. Louis region. Welcome to all of you this evening.
Thank you.
My first question, there have been so many news items. It seems like all the major news of the last couple of weeks has had to do in some way, shape, or form with the mortgage crisis. You have that $14 billion emergency housing measure. It's working its way through Congress right now. Looks like they're going to have to compromise on that. You've got Fed Chairman Ben Bernanke saying things are looking kind of tough and will continue to do so through the end of next year. You guys must be reeling from all this, trying to keep up with the headlines. And how does that affect your clients?
Well, we are reeling, and we have so many phone calls and so many clients who need some sort of help. And I think we wonder every day, well, what's new? Hopefully, will there be something else that we can help our homeowners with?
Is there a typical person in trouble, or do people that come to you all have different backstories?
Actually, there's no typical type of client. We have clients from a myriad of different backgrounds. I mean, from low income to high income, from all different types of diverse backgrounds. So the typical client that we would normally see, I mean, it's most definitely, it is expanding out now. I mean, we're seeing people as far out as Festus, Missouri. So it's very diverse as far as the type of clients that we are seeing on a day-to-day basis.
Okay, now foreclosure rules, of course, they vary from state to state. And in our viewing audience, we have people who are from both Missouri and Illinois. Dan, would you mind explaining what the Missouri process is?
Sure. Missouri is what's known as a non-judicial foreclosure state, meaning that it's not necessary for the lender to go to court. Most mortgages have what's called a power of sale in Missouri, and all that's required is a default, and the default is determined by what's called the deed of trust, which is a contract between the borrower and the lender. And defaults typically include failure to make your payment, failure to pay taxes, and so on and so forth. So once a default occurs, the lender notifies the borrower of the default and then can publish a notice that would accelerate the loan, declaring the total balance due, and then publishes a notice of foreclosure sale. Has to give 20 days notice. It's 20 days from the date that the notice is put in the mail, which means that the borrower doesn't necessarily receive 20 days notice. And then they also have to publish notice in St. Louis and St. Louis County. It has to be published for 20 consecutive days up until the date of the sale. And if that's all done properly, then the foreclosure sale can be held. It can be continued by the trustee for up to 7 days unilaterally. It could then be continued by the parties also if they agree to a longer period. But then the sale takes place and the deed of trust determines how the money is paid. Typically the money is not sufficient to pay down the full amount of the loan.
And the whole process really happens fairly quickly.
Very quickly, yes. It's 20 days notice.
Oh, my goodness.
So
I'm sure that's a shock to the system for a lot of people.
Absolutely.